Both the World Bank and the International Monetary Fund downgraded Kenya's economic growth projections for the year 2015, a sign that the economy was facing a rough patch. CNBC Africa's Bonney Tunya sat down with Anzetse Were, a development economist, to discuss the possible direction for Kenya's macroeconomic space this year. Take a look.
Let's pick up from 2015. There are different projections, IMF, World Bank, Treasury, and different other players. And we saw a lot of these projections being reviewed downwards towards the end of the year, and in a sort of way that people were feeling, let's get to reality. Yes, we wanted to achieve this, but this is what is happening. Give us a few of your thoughts regarding that situation and how we got to be reviewing our projections.
Downwards?
Yes.
I think there were a couple of factors going on there. I think, first of all, it was just a tumultuous time, a tumultuous year for Kenya in 2015. And in particularly towards the last half of the year, Kenyan government is getting a lot of negative attention. And I think people had assumed that everything was going to be fine for 2015 to roll on well. But then we had other things like El Nino, which impacted us in the weather and all of that. So I think the lesson that I learned in 2015 is that there needs to be a consideration of factors that are not necessarily considered. And the good news, though, is that the last quarter of last year, we grew quite well at about 5.8%. Right. So we're hoping that we'll be able to keep that momentum into 2016, and then we'll see where we go from there.
Are there systems we can put in place to ensure that we can still have our eyes on the projections and have measures to ensure that some of these variables are in check?
I think in terms of looking at projections for Kenya, I mean, it's educated guesswork. But I believe that fiscal policy, monetary policy are very important in terms of informing the type of growth that will happen. As you saw, another factor that I think constrained development last year were the interest rates and the interest rate issue. And particularly, there was a time when government was willing to borrow at as high as over 20%. Right. And so that gave some signaling to domestic markets that they can hike up interest rates. And of course, we know the impact that high interest rates has on economic growth. It tends to mute it. People don't have access to the credit that they need to build and grow their businesses. But of course, another factor that informed last year was the depreciation of the Kenya shilling that was juxtaposed with the strengthening of the US dollar. Right. And of course, as an import economy, and the other fact that we're racking up a lot of foreign denominated debt meant that government was very hawk-eyed around managing the Kenya shilling depreciation. As a result, we saw interest rates revisions upwards in about the middle of last year. It happened twice last year. And it now stands, the CBR stands now at 11.5%. So there were other external factors that pushed up interest rates in order to control the value of the shilling so that our debt doesn't become unsustainable, and so that we try and keep check on the import bills. So we need to understand that even though things such as fuel were eventually coming down in price, the net effect of import bills in terms of the effect that the Kenyan shilling depreciation had didn't make the situation any better for us, and we weren't really able to fully leverage on those. And I think it's just a fundamental question and issue we have around having been an import economy almost since inception, and how can we begin to reorient the economy so that we're more export-led. Right.
Talking about the macroeconomic space, at the beginning of the year, obviously we didn't expect much. If we were to say talk about the forex market, the Kenyan shilling has been sitting at 102 for a pretty long time. It's understandable there's very little activity over the holidays. But speak to us a little bit about the FX, especially the USD-KES relationship going forward in 2016.
I think there are a couple of things beyond FX that will affect the Kenyan economy. I think the first thing that we have to look at that I think will have an impact is inflation. In December, we went above the government limit of 7.5%, and inflation stood at about 8%. And so there may be action this year or this quarter around government taking action to get inflation back down. Now, one of the tricky things about the type of inflation that we're coming up about now is not necessarily due to excess liquidity in the market. It really seems to be more informed by things such as import inflation because of the depreciation of the shilling, and then things like El Nino, which pushed up food inflation, made farming difficult, made transport of food difficult. So there's going to be an interesting dance going on that the CBK is going to have to manage around managing inflation without necessarily falling back on the interest rate game and pushing rates up even higher. Now, when you talk about the forex, of course, we know that the American economy is now officially in recovery, and as the interest rates of the U.S. start to creep upwards, what we've been seeing is a withdrawal of US dollars from frontier markets in particular. And there are two things that are going on there that are a real risk for our economy. The first risk is that there's going to be a strengthening of the US dollar. And as I said, as an import economy, if the dollar strengthens against the shilling, you know, that's going to have implications for us. Are we going to have to manage it again through interest rates? What impact are we going to have in terms of import inflation? How will we control the cost of living as an import economy? But of course, the other problem that we're going to face as a frontier market with the strengthening of the US economy is that borrowing will become more expensive.
In March, you're expecting the introduction of Emma Kiba. That is obviously promising a lot as far as financial inclusivity. We haven't seen this sort of borrowing and these levels, entry levels, as low as 3,000 bob, and is expected to rope everyone in. What will be the net effect of introduction of such a tool into the Kenyan economy?
You mean financial inclusion tools? Yes. It's a double-edged sword. On one hand, it's good to give people who have previously unbanked or who cannot get access to credit, access to those facilities. But often what happens, and this is my experience in terms of impact investment and social enterprise, is that if you don't marry borrowing with education on borrowing, the default is something that you have to look at quite closely. So I think although it is good that there are all these pushes for financial inclusion, making credit accessible to people who previously did not have credit, there needs to be a very strong education component, financial literacy component, so that people understand what they're getting into, their debt service obligations, the implications of default, etc., so that we don't have a situation where, you know, the way it is in India, where people are killing themselves because of a microfinance loan, you know. So I think it's a good thing, but it has to be married with education and financial literacy.
Let's talk about 2016. What are some of the sectors to watch out for?
Well, I mean, I think we should just start by saying it's great that late last year there was an industrialization transformation program developed by government, led by the Ministry of Industrialization and Enterprise. And I think we'll have a lot of good opportunity to get investment into sectors that government itself has set up priority sectors. So this would include textiles and apparel, agro-processing, fish processing, leather. So those are some of the sectors in terms of new investment coming in. You know, there's money actively being looked for in those areas, and you know, hopefully it will be managed well to deliver those sort of returns. Obviously, IT will continue to be a key element of investment for this coming year. And I think all the services around infrastructure are going to become important as well, particularly transport infrastructure. So I think all the ancillary services around transport infrastructure, as we're seeing the SGR make progress, as we're seeing the ports come to fruition and all these other things, I think that would be another area to look at as well.